Do you ever get confused when it comes to education about home buying? It might feel like a game of Connect 4, and if you think about real estate, every decision matters. Like, is it conventional, FHA, VA, USDA, non-QM, jumbo, HELOCs, equity loans? What I'm gonna actually show you is 3 filters that can help down select the best programs for you, so that way you can win the game of real estate. By the end of this video, you'll know how to choose the right home loan for you by covering these topics: 15 program filters, the top 3 filters, which will give you the 80-20 rule, saving you time, stress, and confusion. By the way, I'm Nathan. I've earned 150 plus 5-star reviews by helping home buyers through this process, through education, plus bought and renovated over 15 units, just like this one here. Have you heard of Pareto's principle? You know, it's that 80-20 rule where 80% of the results come from 20% of the time. Same exact thing applies when it comes to home buying and choosing the right loan program. Obviously, before we jump into the top 3, which give you the 80-20 rule, we have to first understand what are all 15 program filters, because that's going to help you become a smart home buyer. So here are the 15. Number 1, credit score. What is your middle credit score? Lenders will look in 20-point increments. That's 620, 640, 660, all the way up to 760. If you have anything above that, that's effectively what they call perfect credit. Number 2, debt to income ratios. How much monthly debt do we have compared to our income? The lending trifecta, trademark pending, by the way, which you can see on the screen here. So what you can see, it actually labels the 3 pillars of your purchasing power: income, credit, assets, aka money in, money out versus money saved. So with this lending trifecta, it translates debt to income ratio into very simple language: what money is going out versus what money is coming in. Number 3, loan limits. Some loan programs will have limits to how much you can actually borrow. Number 4, property eligibility requirements. Fancy words, I know. If you're buying a condo or townhome, these will generally have to be FHA or VA approved. Occupancy requirements. If I'm buying a primary residence, vacation home, or investment property, that's actually going to change your interest rate and your down payment requirement. Talking about down payment, number 6, like I said, down payment. How much money am I putting down? Number 7 is seller credits. Did you know sellers can pay for some or all of your closing costs? So there are limits based on loan programs and occupancy type of how much seller credits you can get. Number 8, gift funds. So if you're using gift funds, either from your parents or relatives, for help for your down payment or closing costs, some loan programs allow it, some programs don't. Number 9, type of home. Is it single family, an attached unit like a condo or townhome, or is it a multi-unit? Number 10, employment history. Some loan programs will have stricter requirements on employment history. Number 11 is documentation requirements. Some will need tax returns, while other programs won't need it. Maybe they just need your W-2. Number 12, streamlined refi options. Government loans like FHA and VA will have a streamlined refi process. Just fancy word for you don't need an appraisal or provide income documentation. Number 13 is credit events. Think like bankruptcies, foreclosures. FHA and VA are definitely more lenient compared to conventional loans. Number 14, renovation loans. Do you plan on doing renovations, and how much renovations? Depending on the answer, that changes the loan program. Number 15, time to close. Some loan programs, depending on the property type, may take longer to close. Maybe you need a fast closing to stay competitive. Now, I know that's a lot, so feel free to screenshot that so that way you have it saved. But out of those 15, let me reveal the top 3, which has that 80 to 20% rule. Top filter number 1 is type of home. Most home buyers actually don't know this, is the type of home has a big impact on your interest rate. So when it comes to conventional loans, let's say it's a single family versus a condo / townhome or anything with an attached neighbor, the attached neighbors, actually that product has higher interest rates compared to the single family. And one little added thing is multi-units as well. Whereas if you go a government loan like FHA, VA, or USDA, they have what's pretty much called blanket pricing. It doesn't really matter the type of house. By the way, I think this is going to really help you, and I call it the loan program shortcuts. I'm going to help you fill it out. It's going to go from VA, USDA, conventional, FHA, and conventional. Now you might be wondering, was there 2 conventionals? Correct. So one actually has a first-time homebuyer requirement and the other doesn't. So I'm going to lay out the minimum down payment requirement and sort of like the shorthand code words. That way, whenever you see, oh, I'm this, you can quickly match it to that loan program. So it'll save you a ton of time. Top filter number 2 is credit score. Having a higher credit score will help you with mortgages, credit card, car loans, but I bet you didn't know this. Could help you get more dates. I'm just kidding about the last one. But more seriously, having higher credit scores, I feel like that's commonly known. Obviously, that's going to help you when it comes to interest rates. But what you may not know is when it comes to government loans, it actually, you may actually get the same interest rate if you have like a 660, 740, 760. So we want to make sure we optimize for the right thing when we're choosing the right loan program. So with that being said, I'm going to show you a graphic when it comes to credit score and interest rate and kind of show you the pattern between conventional and government loans. So here's how I almost like to visualize it. Let's say we have the y-axis or the up and down axis is your interest rate, okay? So again, these are educational numbers, all right? Then the x-axis or the left and right axis is your credit score. So what I'm gonna show you is conventional almost has this gradual increase the lower the credit score. When it comes to government loans, which is what people in the mortgage industry call it, that's your VA, USDA, and FHA, that has like a wider range where your interest rate isn't impacted much by your credit score. Some lenders, you'll actually have the same interest rate from 760 to like even 640, right? So now you can actually see there's like this crossover point. Basically what I've noticed is if you're in this area, it's kind of a toss-up between conventional or FHA. That's where you may want to add another 1 to 2 program filters. So again, those top 3, maybe you add another 2, so that's 5 program filters, or maybe a third one, so that's 6 total, to get a better idea, to get directionally correct. So I'll give you an example is, let's say you're in a toss-up between conventional or FHA, but you plan on doing a little bit of renovations, or maybe the house needs some renovations. I would say conventional may be the better option. It has a more, let's call it lenient appraisal process. So if I were to visualize what essentially happens if you were to, let's call it, add an attached unit or multi-unit to the mix, basically single family, like I talked about earlier, versus an attached unit or multi-unit, technically the conventional graph is going to shift to the right, meaning it's going to be harder to get a better interest rate compared to government, okay? So that what that just basically means is I would need a higher credit score for conventional to win in this situation. But if I were to put a very big down payment, which we'll cover in the next section, spoiler alert, by the way, it's almost like the graph shifts to the left, okay? Meaning we could have a lower credit score and conventional could still win out compared to the government loans, okay? So basically what I'm showing you is that credit score, and then if you have different program filters that may shift the graph to the right, or it might shift it to the left, depending on the filter. By the way, if this video has been helpful or you learned something, give this video a like. Top filter number 3 is down payment. Let's talk about risk-based pricing. What that translates into is whatever a conventional loan is, okay? So FHA, VA, USDA, or government is what I call blanket pricing. So risk-based pricing just means the better my stuff, the better my rates, in simple terms. So basically, if I have better credit, if I have better down payment, if I have a better house type, my rates for conventional will be better. Whereas conventional and VA, or USDA as well, will have blanket pricing where it's not really affected as much. But I'm giving you a warning, okay? You have to make sure you're optimizing for the right thing. What I'm trying to say is if we take 10 years to save up a down payment, by that point, the same house that you were trying to buy would be way more expensive. So you have to make sure I can outsave the market. So please do the math and do the cost benefit analysis. I do have a video on that. If you check on my YouTube channel and search out how to outsave the San Diego market, that'll actually show you conceptually what I'm talking about. Okay, so let's jump right back into the numbers and the graphs. So if I were to illustrate this into chart format, it would look something like this, where we have the y-axis, your up and down is your interest rate, and your x is your left and right. That's going to be your down payment. We have a simple chart that I'm going to show you first. Now, again, this is just simple, just so we can illustrate and educate the concept, okay? So you'll notice conventional, following risk-based pricing framework, gets better as you put more money down. As you can see, going from the left-hand side to the right-hand side, the rate gets better the higher the down payment. However, remember I told you, please do a cost-benefit analysis. You have to be able to outsave the market, because then you run into that scenario where 10 years roll by and you have to make sure you can actually outsave home prices going up. Then what you can actually see is government loans pretty much have the same rate through all the down payments. So in reality, for anyone who wants extra credit and you're talking to a mortgage person, you're like, actually, technically, I learned this the other day from Nathan. So this is actually what the chart looks like when it comes to conventional, okay? It's more of like, it's based in 5% increments. So 0 to 5, 5 to 10, 15 to 25 is kind of like the same interest rates, by the way. So a little pro tip there. And then 25 to 30, 30 to 35, 35 to 40. After 35 or 40, that's where you kind of hit law of diminishing returns. You don't really have an incremental boost, I should say. Obviously, you're borrowing less money, so your payment's going to be lower, but that's kind of like your max down payment to lower interest rate return on investment, okay? But the reason why I like this simple chart, it's conceptually easier to understand, and you don't have to get too confused with these 5% increments and all that fun stuff. Okay, the next thing is a little quick asterisk when it comes to government loans, when it would actually matter when you're putting a down payment. It's when you're hitting a conforming loan limits, or CLL, and fancy word for right now as of recording this, it's $806,000 and change. So if you actually put a down payment and your loan amount goes below that, you may get better interest rates. So that's usually the scenario where government loans, if you put a down payment, that actually does affect it. But let's say you're buying in like the $500,000 price point, government loans will have pretty much blanket price. But if you're in that price point with your down payment, aka your loan amount, where your loan amount might be in that conforming loan limits, or your CLL, that may be a situation where your down payment matters. Okay, so we covered the top 3 loan program filters. Let's pull up the loan program shortcuts so that way you can screenshot this and save you all this time. So let's go down the list here. So VA, I'm going to be adding active duty or veteran and blanket pricing, meaning it's not affected much by credit score, down payment, and home type. USDA will be your rural properties, and it does have income limits. So I would put low to medium income for your local county. FHA will have blanket pricing, pretty easy there. Like I mentioned earlier, feel free to screenshot this. Remember, the goal is to get you 80% of the info in 20% of the time. And then for conventional, that has the first-time home buyer requirement. We're going to put first-time home buyer and risk-based pricing. And then the last one, which is conventional, 5% down. So one before is 3% down, first-time home buyers only. Conventional, 5% down, is just risk-based pricing. Also, if you're watching this far into the video, give me a subscribe. Lets me know that I'm doing the right types of videos. All right, now let's jump into the 3 examples. That way we can take what we've learned conceptually and apply it. So example number 1 is we have a first-time home buyer. They want to put a low down payment, which, by the way, is a very common strategy. There's a study done by NAR, National Association of Realtors, in 2023, where first-time home buyers put about 8% down, and then repeat buyers put 19% down. So what you actually see by that pattern, first-time home buyers utilize a low down payment strategy. Repeat buyers, because they've built enough equity in their house, or their house wallet is what I call it, then they use that to put a bigger down payment on their next house. So you can actually see that in that data point. Also, their credit score is at 670, so they're in between that 660 to 679 FICO range, but they want to buy a starter home as a condo or townhome. So basically, it's an attached unit. Okay, first thing, I'm going to pull up the loan program shortcuts, and doing some analysis here, I think I'm going to be choosing these 3, which is the conventional 3% down, FHA, or conventional 5% down, because in this scenario, there's no mention of rural area, or, they're not an active duty or veteran. Let's pull up the handy dandy graph that shows low to high credit, comparing the conventional graph versus the government graph. More than likely, the FHA will be a better option for this family. So remember, usually the sweet spot for conventional, that transition point between government to conventional, is around that 700 credit score to 720 or more. So however, based on this, because we have an attached unit and a low down payment, so those are kind of like negative additives, this would essentially shift the conventional graph to the right, meaning I would need to have a higher credit score for conventional to make sense. Now we just look for which dot is lower. Is it the green government dot or is it the black one? So we can clearly see that the green government dot is less. So that would be the best program for this particular client without knowing all the other 15 factors, but this will get us warmer rather than colder. So pro tip here, I actually wouldn't stop right there. I would actually analyze their credit report to see if there's any like low-hanging fruit that you can chop off and increase their credit score. And the reason why I would do that is because if I can increase their credit score into the conventional range, then I may choose that. By the way, if you need tips on how to increase your credit score for $0, I made a video on my channel. Feel free to check it out. It's in my description down below. So what does survey say for this first client? Survey says FHA is going to be the better solution. So example number 2, which you can see with this lady, beautiful stick drawing. Next is we have someone who's not married, renting, could put a medium down payment. So let's say 10% down, 740 FICO, and wants to buy a multi-unit. Okay, so adding some spice here. And again, buying a multi-unit is very popular right now because affordability is tough. And this playbook of buying a multi-unit is essentially you live in one unit, you rent out all the other units, that way the tenant pays for your mortgage or a portion of it. That's a very popular strategy. So let's run the top 3 filters: type of home, credit score, and down payment. Because of it being a multi-unit, so FHA would have better pricing technically because remember, it's not detached, so it's a multi-unit or an attached unit. We got to shift the conventional curve to the right. But because of her strong credit score, this actually changes things up. Pro tip, by the way, conventional loans, you can actually put as little as 5% down now for multi-units. Before you actually had to put way more down, 15% for a duplex. It used to be, now it's 5% down, which is awesome. And you can do 2 to 4 units. Before, whenever I heard multi-unit, it was pretty much automatically FHA, which kind of was tough sometimes because back in the day, you would have to supply tax returns, which sometimes is a headache. So now conventional is allowed for 5% down. So going back to this stick figure, this client wanted to put 10% down. So you can see what happens to the graph. So now you can actually see the black dot is lower. So I would actually recommend conventional in this situation. Now, for some reason, this person had a 680 credit score or lower, I would recommend FHA, especially if they're also putting a low down payment. Example number 3. Okay, so we have a homeowner that's looking to upgrade. They have a townhome and want to buy a single family. So that's called a trade-up strategy. So their family is growing. I know I drew 3 people, so there's a missing person right here, but their family is growing, promise. Because they're going to sell their home, they're going to be able to put a large down payment, but their FICO score is 680. So this scenario is interesting. So let's run through the top 3 filters, and we're going to look at the type of home, credit score, and down payment. Remember, those are the 80-20 rule, okay? Now you might be thinking this slam dunk. It's government for sure. They have a 680. The green dot is lower, right? But here's the curveball. They can actually put 25% down. Remember that stat earlier? 8% down for first-time home buyers. Repeat buyers were about 19% down. This client was putting about 25. Since they're putting a larger down payment, we need to shift the conventional graph to the left because of this down payment adjustment. You can actually see now the black dot for conventional is lower than the government. So survey says conventional is the best option. But here's the crazy part. The family's journey all started when they put 5% down to FHA. So that was over 5 years ago. So you don't need to always be an FHA. You can always change it to conventional, and you always don't need to put a low down payment. You can always use equity and just natural home appreciation to work in your favor for the next house. So all in all, those are the 3 examples, but here's another pro tip. If you run into a scenario and you think it's very close between 2 loan programs, FHA, conventional, or another program, then that's where I would add another filter. So remember, those are 3 filters, the top 3, 80-20 rule. If you're really close and you're trying to make a decision, add another filter or 2. So by introducing 5 total, it may show you what direction's warmer or colder, and obviously, go in the warmer direction. So that's a little pro tip. And if it's still close, then maybe add another 2 to 3 filters and go from there. All right, so we covered a lot today. We went over the 15 program filters. We went over the top 3. And we went over 3 scenarios here, talked about Connect 4 and all that fun stuff. So I hope this has helped you during your home buying journey. And like I mentioned earlier about Connect 4, with these filters and this video, it's going to help you think a few steps ahead so that way it really sets you up for success. Also, YouTube wants you to watch this video right over here. Give it a click. I'll catch you in the next video. This is Nathan, signing out.